can it last? Let's talk about that with Matt Miskin. He's co-chief investment strategist at John Hancock Investment Management. Great to see you, Matt. So first, I would ask you, where are you now looking for another shoe to drop, for the other vulnerabilities in the system in the wake of SVB and Signature?
Yeah, the ecosystem around the cryptocurrency space continues to be our highest risk kind of part of the markets. It's amazing cryptocurrency. Bitcoin has been rallying almost every day here, which is probably masking some of the underlying risks that still are embedded there. And then the commercial real estate market. You're just seeing the occupancy rates are still very depressed post the pandemic. Interest rates are much higher, borrowing costs are higher, and the liquidity is just low. So overall, I think you want to manage your liquidity risk as a paramount right now. So you want to think about those illiquid assets, those ones that have kind of potential gating, potential blocks on getting your money back. You want to manage those, and you want to tilt more into higher liquid assets. So those assets that trade frequently, those that you can get in and out of quickly, that's where you want to tilt into as an investor.
So if I'm listening to you correctly here, that means that a lot of the private equity investments that have those longer duration time frames, that have those gates, we still haven't seen the potential fallout there yet. Maybe they haven't had to report yet. I'm just wondering, where do you see the dynamics here? Could we have another shoe to drop in these alternative investment vehicles?
Yeah, so I mean, in terms of those vehicles, yeah, if you have a lot of redemptions in a very short order and they're trying to mark these things to market and they really have to, create some sort of pricing to them, but they can't find a price, then they got to be a price taker, meaning whatever the price is set and whatever they can get, that's what they're gonna be able to get out. I think in broader space, we're seeing still a lot of cash there. So there is dry powder. I think, private equity has opportunities if there are newer investments that, are seeing illiquidity in a fire sale or, depressed prices, they could actually take advantage of that. You just got to know what you own. So if it's an older vintage, meaning something that's been around for a while, they've already put that money to work, and you're looking for that liquidity, you're going to probably have to wait. Newer vintages that are, still have a lot of cash, dry powder, they actually might be able to take advantage of opportunities the next year or so. But overall, more liquid assets versus lower risk assets, higher quality versus lower quality. That's kind of how we would position portfolios.
This is all, I think, useful to individuals who are investing. I'm also curious, though, how we should be thinking about it holistically. In other words, is there anything here at the margins? Are there any more failures that are going to cause these ripple effects through the system, eventually affecting central bank policy, for example, or just the stability?
Yeah, Julian, what you're seeing right now is fiscal policy is really helping the global economy right now. So it's not just the U.S. So this, bailout, we'll kind of do some air quotes on it, because you could call it whatever you want. But that was a pretty significant move in terms of basically just blanket statements saying all depositors are backed. These FDIC limits were there, and now they're just completely backed across the board. They went above and beyond. Since 2008, the fiscal side has been more is more. Meaning they don't, say, well, why don't we wait, or why don't we do a little bit less than, we could. It's been almost this modern monetary theory, kind of thread where, just spend more money. It's okay. And I think that worked in the last decade because inflation was so low and you were able to do more fiscally. But now with inflation, what it is, like this inflation report wasn't good. 0.5% month over month on core is not a good number. And the Fed likely has, they still have an inflation problem. So the fiscal side needs to start making a decision. Are they going to keep stoking inflation, making the Fed's job harder? Or are they going to start actually backing off and saying, look, we've got to worry about inflation still, get this under control, and then save that money for when we have a real problem, when unemployment rate rises, when we go into a recession. That's when we need to save that money for. So unfortunately, I think the events as of late is going to stoke inflation versus bring it down, increase risk in speculative parts of the market for the short term. But we actually think the Fed's job's not done, and they're going to have to stay hawkish until this inflation comes down.
But Matt, egg prices fell 6.7% month over month. Everything's fine. Everything's fine. No, I do want to ask you for a long time, and this is something you and I and Emily, your co-chief investment, we've talked about this a lot. The fact that you guys have been long fixed income for a while, right? Going back to early last year. Now that we have seen this unraveling of SVB bets, like, are there any implications? Are you thinking about things differently at all? Are you in a better position now? Talk me through that, if you could.
Yeah. So over the last 6 months, we've been in, middle of last year to now, we've been advocating moving more into intermediate, higher quality bonds, getting 5% to 6% in income, and sitting and waiting patiently as the cycle keeps going. The cycle continues to decelerate in our view. The Fed is going to be continuing to raise rates. I know that sounds counterintuitive to like bonds and thinking the Fed's going to raise the short end, but this is all somewhat normal in an economic cycle. When the Fed raises rates aggressively, that leads to recessions. That leads to solvency risk, issues in the credit markets, issues in just the banking system. This is actually a relatively normal playbook for a cycle. You want to hold that high quality bond right through the end. And I know that yields rallied a lot in the short term, and now the valuations aren't as attractive as just last week. But at the end of the day, we look at this volatility, you're not going to be able to time it perfectly. Just hold on, keep that high quality bond position right through the end of the cycle. When the Fed starts cutting, the curve uninverts, you get a steeper curve. That's when the new cycle is probably going to start. And then we'll be looking at picking through risk assets, finding the best opportunities there.
All right. A little breathing, calming breathing in these markets. Matt Miskin, thank you so much. Hancock Investment Manager, Co-Chief Investment Strategist, Matt Miskin. Great to see you as always.